Welcome to the Retirement Answer Podcast. I'm Dan Goldie, your host. I'm the author of the upcoming book, The Retirement Answer. And this is the podcast where we simplify complex financial decisions. And today is the day that we are going to have another current events episode. I'm here with Monie.
Good to see you, Dan.
In our studio, in his ADU. And it's current events week. So I'm going to read some headlines. And I'll get your reaction to the headlines. These are very recent, and we're recording this on March 27th, 2026. And that's going to be important eventually to know the recording date. All right, so here are three headlines that are in the news. The first one is from Bloomberg, and the headline is, "Markets brace for volatility as U.S.-Iran war escalates. Oil prices surge." The next one is from Deutsche Bank. "Recession and stagflation risks rise due to Iran conflict." And the third one is from CNBC. "The clock is ticking on the stock market as the Iran war stretches into a fourth week." Are you scared?
Yes, of course. I mean, there's nothing I love more than waking up in the morning and seeing that flashing on my phone. Because the next thing I do is run over to my laptop, turn it on.
And place a trade.
Yeah. And then my itchy trigger finger starts moving as I'm watching CNBC headlines scroll across the screen. And whoever the host happens to be that day, scaring the crap out of me.
Well, we should point out to the audience that today's episode really is applicable to all investors, not just retirees. Although retirees, when it comes to what's really important for them, I think investment returns are key, probably more so than someone who's younger and building their wealth because they have more time to recover if they make mistakes or if the returns are low for a period of time. That will probably be followed by a period of higher returns. And so over a long investment period, things will balance out. But for a retiree, it's more important to get consistent returns, or at least as consistent as possible, given how markets are volatile and they don't deliver consistent returns year after year. But this is applicable to everyone.
It's scary when you wake up in the morning or in the middle of the day, you're going about your business, and everybody now has 24/7 access to information, right? It's just flowing in on your phone, email, laptop, television, it's all there. Mm-hmm. And you just can't help yourself but to react when you see headlines like that. Oh, the stock market's on fire. Oh, it's falling apart. Oh, oil prices have hit this gargantuan level. It's going to cause the entire world to fall apart. And now, you get freaked out. You go in, you see numbers start to fall for these various indexes, and you just can't help yourself. You got to go,
Well, there's an urge, what you're describing, there's an urge to do something. And whether what you do is productive or not is another issue. But there is this urge to have some kind of action in response to whatever it is that you're hearing. And I think this all goes back to our evolutionary history. It's a survival instinct that has remained. And in this modern world, it's not helpful to have these kind of instincts, but it was very helpful for our survival. Yeah, if there's a tiger chasing you or something like that, you better respond or you're not going to survive. Or, for whatever the reason was back then, we have these built-in, people call them biases now. The psychologists will describe them that way, and they have all these different names for the different behaviors that everyone has. But there is an urge to do something. And
so it's like this innate
it's natural.
Need. So what you're saying is it's like this innate need to basically protect yourself from danger.
Yes.
You perceive this as like physical danger, but it's not really physical in the sense that you're in imminent danger of your bodily harm. It's financial harm.
But I think your brain doesn't interpret it like that. Right. Your brain thinks it is dangerous to your body or something that's triggering this response that we all have. It's totally natural. So these headlines come out, as you mentioned, and then you want to do something. So I'd like to point out to you a few things. The first is, let me ask you a question to start with.
Yeah.
How far down has the stock market, the U.S. stock market, gone since the day of the war? And the start of the war was what day? I had it down here. February 28th is the date that I have as the first day of the war until the close of trading last night. How far down do you think the stock market, the U.S. stock market, is over that period?
That's a good
question. It's about
question.
a month.
I really don't know. And I'll tell you.
What's your impression? What is your...
I would say 0.5%.
That's it?
To 1%.
Well, it's actually down about 6%.
6%. Okay.
But the reason I'm asking you that question is, you have all of these terrible headlines going on, and the markets really haven't moved very much. They've gone down a little bit.
By the way, do you know why I don't know?
Well, I'm glad that you don't, but no, I don't.
It's because...
You're working too hard.
Well, no, it's because you told me when we first met to stop
looking at the markets.
to stop playing around in the markets like that and to get really good diversified funds and then just walk away. And that's what I've done. And I've been healthier for it, to be honest with you. I don't wake up early in the morning freaking out
You're
anymore
not worried about
on
it
these things.
so
I just walk away. So I honestly have not looked. I really have not looked. Okay. I'm going to ride this one out. And
that's fantastic. That's, I think, the right thing to do.
Yeah.
So we have 3 weeks or so of these headlines coming up, and I would have expected that you would have answered something like, well, it's got to be down 10 or 15% or something in response to what's going on in the Middle East. And so the fact that you said 0.5%, that surprises me in a good way. I'm glad that you're not looking at it.
I've stayed away. Honestly, I spent way too much of my life on the roller coaster ride of markets up and down. And it really has an impact on you. You have a hard time sleeping. You're up all night trying to look at the latest research on whatever from whoever. Wake up early in the morning again, trying to... And frankly, I have never been very successful. After I thought I was pretty good at it until I talked to you and we started discussing how investing works and compounding and the way that, really good funds can produce wealth. And I realized there's no point in me continuing the charade of thinking I'm a really good investor. So easy, just walk away,
Yeah. Okay, so here's another question for you. It's commonly thought that certain assets are good to buy during stressful times, during wars and such. One of those is gold. People say you should buy gold as a stable asset to protect yourself from inflation and so forth.
Never understood the need for gold, but we can talk about that if you want.
And silver. Nowadays, silver has been pretty hot, and so people have been focused on that if you watch the news or something, and people are trying to tell you what to trade.
Well, silver is actually a useful commodity, so I can understand why silver's hot because it's used in a lot of electronics and batteries and so forth. But gold, I never understood that one. That one is that one's a little perplexing to me.
Okay. Well, in any case, what do you think, how do you think those assets have done in this period from February 28th until the close of trading yesterday?
I figure they've blown up. They've gone up quite high because people are flight to safety.
Flight to safety,
yes, that term. I've heard that on CNBC multiple times, yeah. So
the return on gold over the same period that we've been discussing, minus 15%, minus 15.2%.
Wow.
The return on silver over this period of distress, minus 26.4%.
Wow. I mean, I remember
the opposite of what you would expect.
Yeah, I mean, I remember leading up to the war, I had family members pinging me who were doing this. Like, are you buying silver? Are you buying? I said, no, I'm not buying anything. I put everything into funds and I walked away. Why aren't you buying silver? Put everything into silver. Silver's blowing up. And now you're telling me it's down 26% from the time they were telling me to buy it. So I'm glad I didn't get into all this stuff. And then it's perplexing, though, because you would think that if people are, running to this flight to safety to these commodities, why would it be down 26% then?
Because that's not happening.
Okay.
We think it should happen, but obviously it hasn't happened. The reverse has happened, so there's been profit taking and so forth. There's got to be a reason for it. No one knows with markets. You never know what the real reason is because it's based on the movement of millions of people. You
know what's interesting to me? Now if I contact those same family members and go, so what happened with the silver? Oh, they're manipulating the markets. I was like, who is they? Define who they are that's manipulating the market. So can you talk a little bit about that? I mean, I'm really perplexed because you're right. People tend to have these biases, right? They tend to act on them. And then when things don't go their way, there's always some magical force that's acting against them, and it's a deliberate force that's acting against them. And I think that's a horrible mentality to have because, after talking to you and reading a few of the things that you recommended and looking at Dimensional and the kind of research that finance experts actually do, there is like this magic force doesn't exist that's working against you. I mean, there isn't a secret consortium of people just, twiddling their thumbs in the background and going, oh, I'm just going to dump all my silver now too.
Let's talk about markets and how they work because it's a mystery to most people.
Yeah.
Just as investing is a mystery. Okay, so I'm going to give you some figures that are going to be, I think, surprising to you and very astonishingly high. Like it's hard to really wrap your head around how large these numbers are. But so what I did last night was I got together the market values of various the global capital markets, let's say. And the numbers are pretty staggering. It's really hard to, like I said, put your head around it. But the global stock market value, the market value of the market value of the whole global stock market. And the market value is basically the net worth of the market. It's like can't remember the exact definition, but it's the number of shares outstanding times the price per share, and then you aggregate all that together. And
all the market capitalization, basically.
Yes, it's market cap.
Yep.
So I'm trying to define what market cap is. It's the size of the market. Think of it as like the worth, the value of the market.
Right. And for those of you, I don't know, I'm assuming most of our audience probably has traded stock, but for those of you who haven't traded stock, if you look at any stock, you can see the number of outstanding shares, and then there's a price associated with each share. You multiply the price by the number of outstanding shares. We call that the market capitalization. That is how much the company is seen as being worth to the market at any given time.
Yeah, that's exactly right. So it's similar to like if you think of your house. If you're wanting to put your house on the market, you know about this. It's only worth what someone is willing to pay for it.
Yep.
So this is the equivalent in the stock market. And so the value of the global stock market is around 130 to 140 trillion US dollars. And the value of the global bond market is actually slightly larger. It's around 140 to 160 trillion dollars.
Wow.
And if you add all this up, you add real estate to it, you add various other markets that exist. You can add gold to it, what have you. It's around, I'd say, 300 to 400 trillion dollars of global capital markets, that the wealth of the markets. And then if you look at the amount of trading that's done on a daily basis, it's in the hundreds of billions of dollars every single trading day of securities that are exchanged between a buyer and a seller.
Sure.
Hundreds of billions of dollars a day. So imagine what that means for how markets work and how the prices of these securities are moved in response to all of this activity that's done. I mean, these are enormous numbers. So do you really think it's possible for you or me as an individual investor, and I'll show you some figures on professional investors and how they do in markets. But what about you and me and your relatives? How are they going to compete with computers largely that are trading hundreds of billions of dollars of securities every single day?
Well, I think you touched on two things there that we should probably clarify to people, because I think a lot of people don't know. One is the sheer size of the markets, because we tend to be, I can tell you, when I say we, I'm talking about myself, my friends, relatives that think we know what we're doing trading stock, right? We tend to have these blinders on like horses do when they're you focus on the 2 or 3 or 5 or 10 stocks. We call those equities, the 10 equities that you tend to primarily buy
that
or
you
trade
follow.
Or that you follow.
Mm-hmm.
And so you tend to think about the scope of the market with those blinders on. You don't think about the $400 trillion of value and the variety of market participants, the millions of market participants. And then on top of that, you don't think about this high-speed trading with machines that have algorithms that run 24/7 across the world. I mean, this stuff gets so sensitive that they actually place the machines within a certain distance of the trade execution that they exchange, because fractions of seconds and milliseconds make a difference in how these things trade, right?
Right.
So something that you could never perceive as a human being, ever, which is a fraction of a second or a millisecond, makes a difference in the trading outcome that these things do. You just can't compete with that. You can't. And I think that's something that you've taught me over the last maybe 3 or 4 months. We've been talking to each other, because I had those blinders on, right? I mean, I tend to focus on tech stocks because that's what I do for a living. And you tend to extrapolate that the entire market kind of is what you're focused on there, but it's not. It's this huge consortium of $400 trillion of value and millions of participants, many of whom are automated, that you can't compete with.
Yeah, you're exactly right. You described it, I think, is very accurately. And so imagine what that means for securities prices. When you have all of this activity going on, what I think it means is, these prices are very informationally efficient. Like this is markets reach an equilibrium for all of these securities because traders are trying to make money, all of them, and there's buyers and sellers, and the buyers have a certain point of view and the sellers have a perhaps opposite or different point of view. And the price that they end up agreeing on and trading on is going to be some sort of equilibrium price that reflects all of the known information that is out there in the world about these securities that are being traded. So again, what this means is, number one, you're not going to beat the market. There's very, very little chance. If you do beat it, it's luck. It's not because you're faster or smarter. And that's the lesson, I think, that needs to be presented and accepted, is exactly what you've done in the last month since this war started, is you've just ignored the headlines. You've ignored the news. You've ignored your money and just let the markets work. And so what we all need to do, I think, is we need to be comfortable accepting market returns, because the market return is actually a fair return for the risk that you're taking. And you're not going to be able to do better consistently enough to make it worth your effort to try to beat the market.
So that was my next question is, what do we mean? Like, can you explain to people what market return means in this context? How do I, as an individual investor, say, okay, Dan, you told me stay away from this volatile kind of trading. Don't follow the headlines. Mm-hmm. Focus on market returns. How do I do that? How do you focus on market returns? So it's now it's about execution. It's if I want to follow Dan's advice, what do I do to assess what market returns are, and how can I get a piece of the market return?
The easiest way is to invest in a mutual fund or an exchange traded fund that tracks a market in some way. The simplest, oldest version really is indexing, some type of index strategy.
Okay.
That was started in like the early 1970s, late 1960s. I've forgotten the exact date. I wrote it down in the book, the history of when indexing started and the time that it started. And nowadays, there's more sophisticated strategies that have all the advantages of indexing, but don't force themselves to track any particular index, which has some advantages and results in slightly higher returns, I think, for those strategies. That's the way that you would capture market returns. And the market return is basically what you would read about online or in a newspaper about how the market is doing, like the Dow Jones Industrial Average or the S&P 500. These are the most commonly known markets. If you can buy securities that track or approximate the return of those markets. So that's a market return. And it's not a free lunch, by the way. Like it's you're taking risk and you're being compensated for that risk that you're taking. And the risk is the volatility in the market, prices going up and down, sometimes quite a bit. And the uncertainty of the return that you're going to get, even over the longer run. You're not 100% certain that you're going to get the return that you expect when you invest in the markets.
I think a lot of people don't understand that. I think a lot of people don't know about index funds or mutual funds, or they find it boring. That's the other problem. So as a financial professional with like multiple decades of experience, you're telling people right now, stop using your trigger finger, walk away, go buy a fund, or do some analysis, or find a professional that can get you into a fund that's diversified. The problem is that person's going to go home and they're going to see another headline, and they're going to see another friend or a colleague ping him and say, I just made, $50,000 on a trade with, on NVIDIA, or I just used some complex derivative or options call to do XYZ. What do you think about that? What's your advice on that? I'm just curious, as a financial professional, if someone comes up to you and says, I just made $100,000, what would be your next?
The next question would be, okay, well, what about your losses?
Right. That's what I was getting at.
Did you also lose $100,000 on another security that you bought?
Right.
What's the total record? And I'll show you, because actually the records of professional investors have been tracked for decades and decades and decades. And we can go through these numbers, and you'll see that even professional investors have a very hard time beating markets. It's rather humorous. In fact, the first time that I got some of that data back when I was just starting in the industry, we're talking 35 years ago. This is in 1991. I started seeing the same numbers that I'm about to show you here that just repeat themselves year after year, decade after decade. It's the same figures, which is basically that markets beat professional investors a very high percentage of the time. And because markets work very well and they're informationally efficient and they've got all this trading volume going on, and prices reflect the information. That's the aggregate view. It's an equilibrium value of the market participants. And there's millions of these people, or these bots, or whatever it is that's trading, that computers are trading. So I can't remember what your question was, but basically, my response is, if someone thinks that they've beaten a market, let's evaluate that more carefully, because even professionals can't beat the market.
Right. Well, that's exactly the point I was trying to make. Is a lot of people will be very quick to tell you about the successes they've had in the markets, but they won't be as forthright about the losses they've had. And it's kind of like gambling, right? You go to a casino and you make it big a couple of nights. You win a few $1,000s a couple of nights, and you share that story with everybody, but you don't tell everyone about the nights you lost thousands of dollars. It doesn't kind of compute when you do that. You kind of want to forget about it.
Well, that's what I'm saying. I was about to say, you probably just put it out of your mind. It's natural human response again to, if you failed in something, you push that away and you focus on your successes.
Yeah, and I think that's the key here, is we tend to forget about all the bad ones. I sat and thought about that the other day. How many times, it wasn't the other day actually, it was a few months ago when we first met and we had these discussions, like, how many times have I thought I've done well, but I just how many times did I pull? And all you got to do is go back and look at your trading results. Just look at your tax forms at the end of the year, and it tells you wins versus losses. And, just go back 2 years or 3 years, and what you'll find inevitably, at least what I found inevitably, was, the best I ever did was like 10%. If you take all the losses into account. So what am I getting for that 2% of aggravation on a daily basis, trying to push buttons and follow headlines? And so if I can make 10% or 8% or even 7% year after year consistently, I might as well just let the market do its thing and I buy an S&P 500 fund and walk away.
I mentioned earlier that professional investors have been documented for decades now, that they have a very hard time beating markets. So let's look at some. This is a current report from Dimensional Fund Advisors. It's a firm that I've used for a long time, where they believe in this in the story that I'm telling you now about how markets work and so forth. And they have mutual funds out there that they manage to deliver returns of the markets. They run this study every year looking at all the mutual funds in the marketplace. And these are domestic funds. So these are U.S.-based mutual funds. They invest internationally, they invest in bonds, and they invest in the U.S. stock market. But these are U.S. domiciled funds.
Sure.
There's about 4,600 of them in this report that they ran at the end of 2025. And the data here mirror exactly the same information that I remember seeing 35 years ago when I entered the field. Because the story is the same and markets work the same way. So you would expect the numbers to be pretty consistent. So let's go through this quickly.
Yep.
All right. So what they're looking at here, this is as of December 31st, 2025. They're taking all of these 4,600 funds and they're calculating how many of them, what percentage of each one actually beat its benchmark. So each fund is going to have a published benchmark that it should be measured by. And what Dimensional is doing is they're looking at the returns over these different periods and to see if these professional fund managers and the mutual funds and exchange traded funds that they're managing, if they beat the market. I mean, if they do, what percentage of them do it? So over the last 10 years, 15%, 15% of all of the equity fund ETFs and mutual funds beat their benchmarks.
So 15% of 4,600. That's it.
Well, it's not 4,600. It's just the equity fund. So it's actually 3,180 at the beginning of that 10-year period.
It's
only
still an F grade.
Only 15% survived and beat their benchmark.
Wow. And so that's survived and beat their benchmark.
That's correct.
Wow. So that's an F. That's like below an F. So if you get 50% or lower on a test, you get an F. We're talking about 15%, not even 50%.
15%. Okay. And so now that's over the last 10 years. If you stretch it out to 15 years, the percentage of winners drops to 13%.
Oh, man.
And if you stretch it out to 20 years, which is not really an investment time, that's not that long. Your retirement horizon is probably 30 or 40 years. This is only 20 years, 12%. 3,000 funds started 20 years ago, and 12% survived.
So help me understand, what happens if a fund doesn't survive?
They get removed. They get closed or merged with another fund.
Okay.
Anyway, the point of this calculation, the reason I'm bringing this up to you is, number one, I've seen this for 35 years. This is not new. This is not some thing that you can't rely on. I mean, it's happened repeatedly over and over and over. And the numbers are very similar every time. It's a very small percentage of professional investors actually are able to beat whatever their benchmark is. Now, this is after costs and so forth. So another thing that you find in the data, and this is also in the dimensional report, is the funds that have the lowest costs actually do a little bit better. The ones that have a higher cost do a little bit worse, but they all do poorly. And then those funds that trade more, they call it turnover in the industry, where inside of the mutual fund or the exchange traded fund, they're buying and selling, trying to beat their benchmarks and add value.
Let me guess.
The more they trade, the worse they do.
Yeah.
So what you really want is to accept market returns and buy an index fund or a dimensional fund or some kind of strategy that has the characteristics that have been shown to work, which is low turnover. You don't want the fund to be doing a lot of trading. Low cost. You want the fund to be relatively inexpensive compared to all of the others. And I would say not tracking an index, not forcing itself to track an index, because there are some issues there that create a little bit of drag on performance. So there are a number of these kind of strategies that are out there. That's the way you asked me earlier, how do you capture market returns? Well, that, in my opinion, that's the most efficient way, the best way to do it. And then there's some other data here, though, and I want to bring this up. This is where you look at the performance of different managers over time. So we know that a very small percentage of them actually beat their benchmark. But then what you want to know is, and again, I think this supports the idea that markets work very well. They're very informationally efficient. If you take all of the, let's say, equity funds, that's what Dimensional has here in this particular part of the study. They look at 5-year rolling periods. So in this study, there's 11 of these 5-year rolling periods going from 2011 to the end of last year.
Sure.
So these rolling 5-year periods, what they're doing is they're looking at and ranking by performance level the top quartile of mutual fund performers, and then the second quartile, the third quartile. So these are the top 25% and the next 25%. And then what they're looking at is over the 5 years later. So let's say in 1 year, you take all of the good performers and you put them at the top of put them in the top quartile. So these were the best performing funds. And then you track how they did over that 5-year period. And what you find out is that they're just as likely. I'm sorry, it's over the next 5-year period. So over one 5-year period, if they're in the top 25%, then you look at them over the subsequent 5-year period.
So in other words, do they have a consistent track record?
That's right. So there's no persistence.
Right.
So you're an engineer. So statistically, if things were just totally random, what percentage of those top 25% would fall in the top quartile this next 5 years? What percentage would you expect if it's just totally random?
It's totally random? I don't know.
25%.
Oh, okay. So this 25%
they just resort themselves.
Okay.
So the top 25% in the first 5-year period, they're as likely to be in the bottom quartile over the next 5 years.
Got it.
As they are to be in the top quartile again.
Right.
You would expect it to be, if it's totally random, you'd expect, and I think what I'm saying is if markets are working well, you would expect the top 25% of performers, the next 5 years, about a quarter of them are going to stay in the top 25%.
And somebody else will shuffle in to the top and somebody will shuffle to the bottom, but it'll always be that you'll never beat that quartile is what you're saying. In other words, you'll never beat that 20. It'll never be more than 25%.
It appears random is what I'm saying.
Okay.
Which means markets are working really well. So if you're a top 25% performer, you're a high performing mutual fund over a 5-year period. And then the next 5 years, what I'm saying is, and the data support this, is you're only 25% likely to stay in that top quartile.
Okay. And now I understand what you're saying. You're saying that the chances of you from 1 year to the next
5-year period
or for a 5-year period, which is that period of measurement, is not going to be any greater the next year. So in other words, past performance is no indicator of future performance is what you're saying.
That's right. In fact, you'll see that in a lot of advertisements from financial services firms. Okay. They have to put that on the bottom. Past performance is not indicative of the future.
Right. That's probably where I got it in my head and I just don't remember. Yeah.
It's truly not.
Yeah. And so, by the way, guys, this is the first time I'm getting exposed to these numbers because Dan purposely did not share this with me prior to the podcast. So I'm actually dumbfounded by how poorly they perform.
Well, it's how poorly they perform.
Don't these people make like millions of dollars a year?
I don't know how much.
Why didn't I get into this business? Yeah.
It's how poorly they perform over the long run, but then also how there's no persistence in performance. It appears random. It's basically what you would expect by random chance.
So basically, it's you're throwing a dart at a dartboard with your eyes closed and hoping that you hit something. And you throw a dart enough times, eventually you're going to hit something there. And the randomness is basically that.
Some people, I would say many people, if they're going to pick a mutual fund that they're going to invest in, first thing they're going to do is look at the track record.
Right.
How did this fund do over the last 5, 10, 15, whatever, 20 years? And what the study is showing you, the data support, it means nothing.
Yeah,
the past performance means nothing.
Nothing.
It appears random.
Wow.
They're just as likely, if they're a good performer over a certain period, they're as likely to be at the bottom of the list over the next period as they are to stay at the top.
Well, it makes sense to use 5 years because if you're doing research and you look at 1 year and then you look at the next year and you look at the next year and it looks really good, you're not going to go to the fourth and fifth. Or if you look at 5 years, you're probably not going to look at the next year, right? So people probably stop looking. People probably stop doing their research after, 3 or 4 years. Like, oh, this is a great fund. It's been consistently good over the last 4 or 5 years. Or maybe the fund that you're looking at doesn't even have a 10-year track record. It's got just the 4 years and it looks really good. But just because it was good in the last 4 years is not an indication it's going to be good in the next 4.
That's correct.
That's basically what this data is telling you is that
it appears as though skill is not rewarded,
right.
and it shouldn't be. That kind of skill shouldn't be rewarded by the market. Because if you were evaluating, let's say, students of some test, like an SAT test or some kind of exam like that, you'd expect that the smartest students would pretty consistently, if you had the test run 10 times or 100 times, that the smarter students would pretty consistently be at the top of the ranking of these.
And that's how grading systems work. That's essentially how, acceptance to college, all of this works, right?
Because skill is skill is rewarded.
Yeah.
But it doesn't appear so with these numbers.
It's really shocking to me, honestly. I'm kind of dumbfounded that you have all of these professional managers who are constantly rambling on Bloomberg, CNBC, and I don't need to name them. Everybody knows who I'm talking about. Teams of people, and it's like, and they've glorified these people. Mm-hmm. And you're basically telling me they basically all have a grade of F.
The data doesn't look good. It doesn't look like this skill is rewarded very often, if at all, by markets. And to me, it's rather obvious if you think about how markets work that we just talked about earlier. Markets work really well. All of these billions of dollars being traded all the time. Prices have to incorporate information very, very quickly, if not immediately. So how are you going to beat that? How is a professional manager going to beat that?
They're not.
They're not. And that's why these numbers look the way they do. It looks as though it's random, meaning there's no skill there that appears to be rewarded by the markets. That's the way it looks to me. And I've always counseled people, and I've always put my clients into funds that are similar to Dimensional and other types of strategies that are considered passive by a lot of folks, although there is some activity going on to track markets properly.
So let me recap on what we've been saying. Basically, it's that headlines. Essentially, what we're saying is that headlines and headlines in general are made to cause you to react to something, right? To get your attention.
Well, they're made to make money for the media wherever this is being published. They want to attract your eyeballs, and they want you to watch a lot.
Attention, right? And they want to sell advertising.
Yeah, they create emotion, an emotional response. They create fear and makes you watch more and watch the next episode. So that fear results in some kind of reaction on your part, and it's usually a negative reaction. In other words, it results in some kind of problem with your portfolio down the line. So you basically go get your itchy trigger finger, like I used to do, sell, and you sell at the wrong time. And the best way to protect yourself against this kind of behavior, to walk away from this kind of volatile behavior that doesn't result in actual performance in the markets, is to buy and hold and the kinds of stuff that I'm kind of more interested in, you giving people advice on what they should be buying, the kind of categories of things that they should be buying, and what characteristics do they look for? What is the characteristic that I would look for in a good fund? Or we already talked about that. Okay, funds that have low turnover. So they're not trading internally very much. Okay. They're just holding on to the securities that they own. Mm-hmm. Low cost. Okay. And you also want them, if you have a taxable account, if you're not investing in an IRA, you want them to be tax efficient too. But those two characteristics I described should make them pretty tax efficient. So they're not generating a lot of capital gains tax and so forth. That's what you want to look for. Something that's going to deliver market returns reliably. And those are the characteristics that I've always looked for over the many years I've been doing this. And when you're looking at benchmarks, and comparing, say, some percentage to these funds, the best benchmark to look at is, okay, what's the market done overall in the past year? And what has this fund done overall in the past year? But you have to look at it on very long timescales, it looks like, because you're saying that past performance is not indicative of future performance. So what would you use as a characteristic to say this dimensional fund is something I want to put my money in? Do you look at the length of time that the fund has been No,
running?
Not the length of time. No, I look at just the characteristics I described to you.
Okay.
And all of their funds fit those characteristics. That's what they do. And there are other providers. Vanguard is one. There's a number of different providers that follow a similar strategy, a similar philosophy, I should say.
Okay, so low cost, low turnover.
Tax efficiency.
And tax efficiency. Okay.
And widely diversified.
And widely diversified. Okay, that's a key factor there.
Well, and that's how you capture market returns. You have to be well enough diversified within your portfolio that you can reliably get the return that a broad market segment.
And is there a way for an individual investor to know how broadly invested something is, besides, of course, the literature that tells you we're widely diversified? Is there like some number or some value that tells you that the fund is widely diversified? Some indicator?
The number of securities that the fund owns will tell you. And so you can find all kinds of evaluations of exchange traded funds or mutual funds from Morningstar. There's a number of different providers online where you can look and see all the different funds that might be available that fit these criteria, and how many securities they own as part of their portfolio and so forth. But it's as simple as that. It's really, you don't need to look at track records. You don't need to evaluate the managers of these funds. To me, it's the characteristics that we just described, that we just discussed, that are what you want to look for. And there's a lot of choices now. There's, I would say, hundreds of these funds that are out there. That's it. I mean, it's as simple as that. And this is important, in getting back to retirees. It's important that retirees get market returns, because if they make mistakes and get lower returns than they otherwise could have had, the market delivers a certain return for risk taken. And that's what you need to have a successful retirement. You have to beat inflation by a meaningful percentage. So you've got to be a good investor. You got to be a smart investor.
And so you mentioned Dimensional, there's Vanguard, probably Fidelity, a bunch of these companies do have a majority of funds, so people can go look at these different companies or talk to their professional and
yes, there's
ask for these.
They have exchange traded funds. They have mutual funds. Exchange traded funds are like a mutual fund. It's a diversified portfolio of securities that's professionally managed by a firm. But the main difference is that exchange traded funds, they do trade like a stock. So you can buy and sell them during the day, during the trading day. Mutual funds trade at their net asset value at the end of the day. So you can't trade them. You can't buy them in the middle of the trading day. You get the price at the end of the day.
Oh, that's nice to know. I didn't know. I actually was going to ask you, what is the difference between the two?
That's the primary difference between the two.
Okay.
In terms of practicality, that's the way I think of it, is, that's the main difference. But these are valuable for retirees, for all investors. I think that's the proper way. To me, it's, in my opinion, that's the way that people should invest. It's the easiest way to get these diversified portfolios of securities that will give you the market return. If you try and do it yourself, buying individual stocks or bonds, I mean, you just can't do it. It's not going to work well. It's so much easier, and you can get the diversification and everything that you need at a very low cost by using these strategies.
Wow, that was a lot of information to digest. Can I regurgitate some of it for the audience? Okay, so we started with the danger in following headlines and trying to time the market or beat the market, and being careful with your itchy trigger finger. Then we talked about the sheer scope of the market and the efficiency of the market, right? You said market's worth about $400 trillion, and hundreds of billions of dollars are traded per day. And a lot of that is high-speed trading with machines doing it. You cannot time or beat the market as an individual. Have we all had stories of friends or family members that just got it right on one, and maybe they were lucky enough to pull their money out and maybe put it in something else like real estate or something else, and they did well? Yes. Do we hear about the times when they got it wrong? Usually no, right? We don't. And it's the same for yourself as an individual, right? You tend to shove all those losses under the rug and not talk about it. And the one time you do really well, you talk about it. So what I would say is that what we talked about is that this whole, I'll call it the GameStop mentality, because everybody watching this is probably familiar with the crazy GameStop stock that went through the roof during COVID for no reason whatsoever, except for some idiot talking about it online, right? And we also talked about the fact that the best way, the most logical way to get a return for the risk that you're taking when putting stuff in the market is to buy into funds. And when you're assessing a fund, do not use past performance as an indicator of future performance. That was very clear. And the characteristics Dan talked about, which were low cost, low turnover, so the fund doesn't continuously trade stock or try to actively beat the market, and highly diversified, and good tax characteristics, which come from the low volatility, the lack of, the not trading as often. Did I capture that, Dan?
Yes, I think that's very accurate. Yeah,
perfect.
And those are the characteristics I've always looked for, and it's worked well for me. And it is a lot of information to digest.
It is.
And I remember back when I was just getting into the industry and I was starting to get exposed to this kind of thing. And, I remember thinking to myself, kind of smiling and sometimes outright laughing if I'm, in a room by myself, because sometimes these figures just are too funny, and I remember thinking, well, my gosh, I'm a former professional athlete, and this was right after I was off the tennis tour. I was thinking, this is not the way the tennis tour works. The better players consistently beat everyone else. It's your ability, your skill is very much rewarded in professional sports. How can this be so different? And then I just realized that, oh my gosh, this has to be the way the world works, because
no one beats the market.
It's when you think of all the numbers and you look at all the data, it's pretty clear, at least to me now, and back then it was the same. It was as though there's a message here that we need to accept, which is this is not professional sports, and the fact that markets work the way they do and work so well, to me says, I'm not going to even try to beat the market. I'm just going to accept market returns, and that's plenty good enough, because market returns are a fair reward for the risk that you've taken. So you want to diversify your risk across lots of different securities. I don't want to get too much into that. We'll get into this on the investment thing.
Sure. The
investment episode when because it's written in the book, and we're going to cover the book chapter by chapter. So it'll be coming up soon, everybody. But this is essentially the message that I think everyone should understand, and everyone can do what they want with their money and invest how they want. But this, to me, is the academically evidence-based supported way to invest.
No, I totally agree. I've had a couple of months of pretty sound sleep and lack of constant worry. And like you said, we're going through this geopolitical crisis right now. I'm not even looking at my portfolio.
I think that's the right thing to do.
I found a couple of good funds, bought them. They're in my IRA. And I'm just going through life very happily every day.
Glad to hear
Getting
it.
up and going to work and doing this podcast.
Okay, well, anyway, that's I think the main message, and I enjoyed going over this with you. In the next episode, we'll probably go back to the book, but perhaps we'll find another current event topic with all that's going on in the world. Maybe something else will come up. But I think this covered everything that we wanted to do today, and I enjoyed it and look forward to next week.